Hi everyone, it's Mark here at TSLA, and I'm happy to report that we closed in the green today for Tesla, and that's after six trading days of red closes. The closing price was $231.28. That is an increase of $15.79 per share, or 7.33% over Friday's close. We're also seeing a little bit of exuberance continuing to the after hours trading. It's currently, as you see on the screen, $232.93 in the post market. And that kind of continues the trend that we saw on Friday of last week, where Tesla was up a couple dollars a share after hours. Now, like I mentioned last week, that could have been just a little bit of price suppression due to OPEX and especially the massive amount of Tesla options that were expiring Friday. But it's always good to see Tesla continue to be bought up in the after hours, because it's kind of it's really a sentiment thing where people are looking at the close and they're seeing the close was decent and it wasn't a sell-off close, that maybe that they should dip their toes in the water and pick up a couple of shares, especially if you're just coming home from work and they weren't able to pick up a couple of shares during regular trading hours, which is totally understandable. And that's why after hours trading kind of exists, and also just to react to late news that comes from that concerns the market. As you can see on the screen as well, is this area in the volume profile used to be more of a valley, but with this recent price action, it kind of filled up the bottom portion of the valley about halfway up, and we're going to try to have to fight our way through the remaining amount of very low volume profile if you want to see a close higher than today. What could that look like? Let's go in a smaller time frame and just look at, well, actually, let's go back to the daily, and you can see how Tesla closed above a couple, it's 100-day EMA. So that's not a bad thing. I think that's a good thing to reclaim certain whatever moving averages that we can and kind of bouncing off that 200 area. So let's go down to a lower time frame, and we'll turn off the EMA and we'll turn off the volume profile. And you can kind of see what our setup might be for tomorrow, depending on how the price action looks. And unless something drastic happens, what I like to see is for bullishness, I like to see a gap up tomorrow. I would like to see it, well, currently it's at where I want it to be gapped up, around $233 a share. I like to see it get bought up a little bit. And this level right here at 235, 236, that could be the first moment that you can see kind of a rejection off of price. What usually happens with a bullish move, it's going to be either or. So there is something I call the non-participation rally, and I can draw that out for you guys. It's a gap up, it's a slight buy, and then it's a flat trade all day long. Or you can have kind of what I think could happen on a bullish move would be a gap up, and it's this darker green line, a gap up, buying to a level, and this is, I think the 235, 236 area would be maybe the first moment of rejection if we have a nice day tomorrow morning. And that kind of sells off all day long until you close the gap late in the day, and maybe you can see a bullish move up to the next level, which I believe will be just above the next strike price of I think 237.50 in that area by the close. If something drastically bad happens tomorrow, or not even drastically bad happens, even just a little bit of pullback or profit taking, that's not uncommon in any stock, is that maybe we kind of either gap down or open flat and kind of sell off and never go green during the course of the day. But the reason I have it kind of drifting down to this price, what I do want to see is that if it ever gets down to 225, that I wanted to come bounce off again. This was pretty respected. It was a level even before today, but if it can come up to 225 and stay above the blue line for tomorrow and Wednesday, I think it's a good setup. But with Nvidia's earnings coming out on after hours on Wednesday, it makes sense that the market wants to kind of position stocks like Tesla or Nvidia that will be basically Nvidia can drag down the market or really pump it up depending on how much of increasing guidance. I think that's what they're pretty much looking for. They already expressed that they're maybe seeing 11 billion, but we do know a lot of orders are piling in for these AI chips, and Nvidia is going to be developing and selling that. If increase in guidance, maybe like another 10, 20, 30%, I think that could sustain Nvidia's run, which will drag up Tesla with Nvidia. And we'll take a look at the Nvidia chart. We can see where it kind of diverged from Nvidia a lot, and then let's see if it can kind of reclaim the trend that they are moving together with, much more than other tech names, meaning that they're outperforming other tech names during the run up into early summer. So basically, I want to stay above 225. We also talked about if we saw a move up today, would this be our entry for some hedging going into earnings in the middle of this week? And of course, Jerome Powell speaking at the end of the week. That is something that I kind of nibbled on a little bit, in the sense of I added a put for every 100 shares, and I went into this weekend actually unhedged, closing my hedges out because they're so profitable on Friday, like 1 minute basically before the close. My puts were actually $14-15 in the money. I don't remember exactly, but they're pretty severely in the money from being purchased 1 week before. So the hedge was actually really perfect. There was only about a 1% loss for 6 days of trading, which is really effective because I had the calls sold on the shares, and I closed that out, I think, Wednesday. And then I had puts that I rode into expiry on Friday. And since they're well in the money, they're basically moving dollar for dollar on the stock, which was very, very effective. So that was decent. Just limit the losses. And so something I want to talk about when it comes to hedging real quick before I forget is that when you're thinking about hedging, when you're thinking about trading on the Tesla ticker, I assume everyone here is holding Tesla shares, and perhaps Tesla makes up a large portion of your portfolio. A lot of really hyper bullish people that deal in Tesla, they're like 90% Tesla or 100% Tesla. And when you think about your position, like holding shares means you're just automatically long. I don't care if you're holding shares in your retirement account, your HSA account, in your IRA account. I don't care where it's at. If you're holding shares, you're long. So when you hear people talking about trading Tesla, and they're talking about, I'm buying leaps on Tesla, I'm buying calls on Tesla, I'm going long via calls, we've seen how leaps and even midterm or really short-term calls really don't effectively work if you try to swing them, meaning that if you try to hold them for like multiple days, it can get rather problematic. Just know that when you want to quote unquote trade Tesla, just remember you're long Tesla already. To go doubly long on a ticker that falls 40% in a month, that really exposes you to a great amount of losses, like double the amount of losses, where it is so volatile that the moves up like today are a good example that a 7% move in a stock that is a quote unquote mega cap stock, like that's good enough just to be long your shares and your positions that you already have. Now, of course, I don't mind when you go long, doubly long basically, because you're hedging your hedges. So we've talked about selling covered calls, but it kind of provides that like there's risk to the upside, right? So how do you hedge your risk to the upside? Is that when you sell a call against your shares, like you don't have to sit back and just let it happen and like, okay, your calls become, sold calls get in the money, and you're losing sleep at night because like, look, I'm losing all my shares this Friday. I'm losing out on $10 a share in value because I need to sell it at $10 less than what the current price of Tesla is at this very moment. Think about it like when you want to buy calls for Tesla and you want to, long calls, use the premium that you collect from your sold calls. And that's your play money. That's paying for your, whatever. I don't want to say it's lotto, but it's paying for maybe just your hedge for the upside movement of Tesla. Because it's going to be really tough for you to say to yourself, okay, let's say you sold a call on Friday last week. and then Tesla goes up 7%. And that call becomes, I don't know, is it up 200%? Whatever it is, depending on the expiration, how far it is, it might not be as violent. But let's say it's a short-term call you sold. And you're like, oh man, it went up freaking $15 a share. What do I do now? Like, I'm not going to come out of pocket, $15 a share times whatever hundreds of shares to protect my investment. We always talked about, when the price moves up and you sell a call against it, your shares, and whenever you can enter in your hedge for your call, and you want to get it as cheap as possible. You want to sell your call high, and when the price of the stock dips low, you can either close out your hedge, or you can actually just buy a cheap call to hedge your sold calls. Now, that is that's something I just want to talk about. Like, you remember, just your long Tesla shares by just owning them in your retirement, your brokerage account. Going into buying calls to maximize the upside. Just know that today's a very good example. Look, you're already long. Your stock that you have went up 7%, while the index moves 0.5% or even less than that. So just kind of get that in your mind. Your mindset is, I'm long already. I'm always long. I'm always long. So when you want to trade Tesla, you're trying to prevent the downside. Trading to the down, basically betting on the downside to hedge your position. Now, you don't necessarily want to go crazy and go net short, right? But what I mean is that preventing a little bit of downside means that you're not suffering the same type of volatility that everyone else is. If you can master, hedging your shares and hedging it kind of both ways at sometimes, that is what you have to do. You can't sell calls against your shares and then pretend like you're not an active investor. Okay? You can't sell calls against your share and just walk away. The internet told me I can sell calls. It's like maintenance free. I'll collect premium. And then if they get called away, they get called away. That doesn't work in reality, because if you are emotionally attached to your shares, you can't just do that. You can't just go to sleep and say, look, I captured a 5% move and I'm capped at 5% because I sold calls, targeting at 5%. I'll collect a little premium. I'll collect 5% on the share value. And then whatever happens after that, I'll just ignore. And then when the calls expire and my shares get taken away, I'll then use that money, maybe sell puts or buy calls again or sell calls again. Look, that doesn't work. When you are long Tesla because you believe in the mission and you love the company, you love the leadership, you love Elon, look, it's going to be really tough for you to separate yourself from your shares without doing everything you can to prevent that from happening, unless you're getting good value for those. Like, for example, if you sold like a 240 call and Tesla's at 241 when it expires, you're not going to lose any sleep. You're probably going to let them expire, maybe get it called away and just buy the shares again. Like, that's not a big deal. But if it's going to be, and I've seen this, like during the run up in May into June, people are selling calls at like 180 and Tesla's at like 240, and they're like losing their freaking mind. So we always talk about, hedging, but we also want to talk about that, you're already long, but also at the same time, you need to manage your hedge, right? And this is, I think it's really important for your own psyche, so you can sleep at night. I think, when you're actively managing your investment, you need to be, I think what you want to do is you want to trade so, big explosive moves to the downside don't devastate your portfolio, doesn't really ruin your spirit, but at the same time, just remember, you're always long, prevent the downside. You'll win out more than everyone else that's investing in Tesla by just taking a couple minutes to be understanding that when you're selling calls against your shares, you're actively investing, you're actively managing your portfolio, and you need to cover it both ways. You need to understand the price action. You need to look at the stock every day. Okay. This whole idea that, you buy shares and you hold them. Okay, let's talk about that. Let's just look at that, what that looks like. Okay, so let's go on a big time frame, and you're looking at Tesla, and right now it's $233.10 a share after hours. And how far are you down from all-time highs? You're down 44% from all-time highs. Buy and hold, you basically have a lost 2 years. Let's look at where this blue line intersects. at the earliest in Tesla's history, and you're right about December 2020. So you're saying to okay, the argument you're making with yourself is like, I'm a long-term investor, but the money I put into my stock over the past 2 years and 8 months has done nothing for me. Like if you're buying Tesla here, if you feel like, okay, I got the pullback in March 2021, I want to go long, and you feel great in November 2021, and then you see your investment disappear by 75%, 2 years later, and less than a year later, you're up only to find yourself flat from purchasing stock 3 years ago. It's not an amazing look, because if you're buying stock anytime around here from December 2020 until now, you're not doing all that great unless you captured this bottom in December 2022. And that has to assume that over the course of the 2 years before the bottom in December of 22 or January 22, you didn't lose all your money with Tesla in those previous 2 years. So I think that if this is such a large position in your holdings, if this is the majority or all of your position, I think it's your responsibility to look at the stock as much as you can. Like, try to be hands-on with it as much as possible, because if you can capture all this premium, because we are in an overall long-term downtrend. Like, we have not made a significant high. Look at, like, we didn't even take out the highs from September of last year. So, and I don't want to do this, but if we were to, let's real quick and just understand this is why, one of the reasons why I think you need to manage this investment is that if you would have bought the SPY at the same time you bought Tesla, you're really not, this orange line is the S&P 500, you're not outperforming. You're up 28% for a stock that is moving like insanely up and down. Okay, so if you would have bought the SPY in November 2020, you would be outperformed by 28%, but you would have been more sane over the past 3 years. You would have been more sane for sure. What if we if we just move up the dates a little bit? If you would have like bought it right before this breakout in December of 2020, you are losing out to the SPY by 17%. If you bought it by the highs in January 2021, just after it broke out, you are down by another 17%. So it's not the greatest look compared to the S&P 500. If you would have bought any time before the all-time high breakout, you're still losing. You're still losing out compared to just the index. Not even the QQQ index, the Nasdaq index. You're losing out on the S&P 500. Let's say you bought the lows in January 2022 during that consolidation before August, and we had that run up. You're still at the S&P's performance. It's not. So if you're sitting in all these shares and you're not trying to get something out of them and use them as a vehicle to make premium on calls or what have you, like when Tesla's at 400, you can come at me and be like, okay, look, like, see, I'm just buy and hold, and I'll be like, yeah, you're right, I was wrong, everyone else is right. But what I think I'm right about is that if you're sitting on an asset that is not appreciating in value for multiple years, and you're saying to yourself, I'm a long-term investor, I think that's irresponsible to your own self, because it's like if you have a Tesla and FSD beta is actually no longer beta, they have a full version out, and you're saying to yourself, I don't want to rent my car out with some autonomous taxi service. I only want the car for myself, and I'm willing to lose that, thousands of dollars a month on not having my car be a taxi. I'm like, okay, that's fine, but you're sitting on an asset that could make you money when you're not doing anything with it. I think it's kind of the same concept. And I understand that. I think the main fear people have is that they fear losing their shares because of the covered calls. And I think that's why they don't want to hedge. And I'm not saying you're wrong, but I'm saying is the mere act of selling a covered call means you're an active trader, and you need to you need to act like you're an active trader. Now, let's go to the news real quick before I know I'm babbling a long time. That's just how I do this. We'll go over to let's go over to Twitter first. I mean, X first. And look at a cool little tweet. We have a tweet from Stock Market News, Evan, and he says Tesla just closed up 7.3% in its biggest one-day gain since March 21st of this year. Now, that's kind of an incredible move because March 21st is before the big move that we had at the end of May into summer, and Nvidia just closed up 8.5%. So you can kind of see how, and we'll look at charts a little bit later, how Tesla kind of recaptured its move with Nvidia, and that's kind of what you want to see because Nvidia is going to be the catalyst that can save Tesla from itself, meaning from all the talk about margins and whatever. The sentiment that Nvidia will bring to the market if it outperforms is going to drag Tesla up with it. It's just going to, like a vacuum, it's going to get sucked up into the air that Nvidia is leaving behind if it was to move up. Now, I think that kind of makes us, ask the question ourselves, what do we do when we get into late Tuesday into early Wednesday? I mean, I think it's going to be an important conversation to have with you and ourselves. That what do we, if Nvidia keeps moving up into its earnings, what do we do with hedging Tesla? Because a massive move down with Nvidia will drag down Tesla with it. It won't be a percent move, I don't believe. But who really knows? Like, I mean, Nvidia can, if Nvidia doesn't guide really, really well, the move down from Nvidia could be explosive in a bad way. Okay. Let's look at a tweet from Sawyer. Sawyer has a little bit of Tesla-specific news that would have helped the bullishness of Tesla today, and that is that Baird Equity Research added Tesla to its best ideas list. And there was an article from Yahoo talking about this. Tesla shares gain as Baird Equity adds stock to best ideas list. It is the brokerage said price cuts and their impact on margins will drive the narrative in the second half of the year, but other potential catalysts for the stock include the launch of Cybertruck, wider adoption of full self-driving, expansion into new markets, and of course, they're not even talking about maybe maybe euphoria that comes with a revamped Model 3 quote unquote Highland. And when it comes to the unknown about margin, like how does the stock react if at the end of Q3 there comes the report that comes out is margins are staying flat at 18.5%, 19.5%. I think people will be rather shocked that the margin can be maintained. I think you guys should really listen to Jeff Lutz. He's on interviews with like Brighter with Herbert, and he has a lot of posts on Twitter that talks about, what's the market is not factoring in is that the cost of goods has come down in a way that is not appreciated by the market, not talked about by Elon and leadership at Tesla. So it remains that could be an upside surprise, meaning that cost of goods comes down, margins stay flat or go up. Now, there's another article that sort of linked to, and it talks about how Guru Focus is mentioning that, Tesla is currently really undervalued based off compared to what they believe is fair value and what their research is. They have their fair value at Tesla at $453. Now, what does this mean? It doesn't really mean anything because we don't know how far into the future that this should be realized. But just to put things in perspective, if they believe that Tesla's fair value is at $453.55, what does a really high fluted stock that they track look like? How do we just compare Tesla's fair value to what they believe Nvidia's fair value is? And they believe Nvidia's fair value, and they consider it overvalued now, with their Guru Focus value being $312.97 in comparison to a close of about $470 a share today. So they kind of put that's your perspective you want to take on this. Like, so it's nice to see some analysts or some websites or some analysts websites talk about how the current price of Tesla is extremely undervalued to the point that it's like basically half of what they think their value is, and that the Nvidias of the world are significantly overvalued. I mean, I think everyone thinks Nvidia is overvalued, but to a very, very great extent. Just a little bit of positive news. Now, I want to take a look at Tesla's options interest, and it was crazy today. the amount of volume that is really suppressing. The 230 calls were just piling up like crazy. And you can see the volume is 139,000 for today at 2:30. This could be kind of problematic for us as the week evolves. Of course, the volumes can really change as stock price changes, and the 138,000 on the 2:30 strike might not even mean all that much as the week progresses. But this kind of served as kind of a cap on pricing. You saw a lot of resistance in around the 228 and the 229 area today until it kind of broke out of that and put a lot of these calls in the money. Like I said, this can be problematic if these calls are not owned by really quote unquote smart money, a lot of fund money or the CTAs. So let's look at the open interest. This is the open interest at the 90 strike and the 100 strike is very interesting. 95 strike is very interesting, and this actually has existed for a while, for some weeks. So this could be just completely irrelevant. And I don't really like the open interest chart too much, but it does reflect the reality is that the open interest at the 230 is reflective of the volume at 230. We're seeing a lot of people on that psychological level creating a floor, maybe at the 200 strike, but you're actually seeing a lot more interest right at the 225. So maybe we get pinned over the next day or so in the 225 to the 230 area. Like I mentioned, when we were looking at the chart earlier, we don't want to see price fall below 225. I mean, if I see price below 225, I might actively be buying puts in the kind of 1 to 2 week out just to cover ourselves through what we have. Powell this week, we have Nvidia this week. Next week we have the PC inflation index. So we need to understand that there's a lot of volatility that's coming over the next 2 weeks, and since the IV crushed really hard, the implied volatility on the options crushed really hard on Tesla, it made puts really, really affordable. And the move up didn't necessarily make them all that much more expensive in my mind. So the puts are fairly cheap, about 2 weeks out. I'm not saying that you should buy them, and that it's just that my what I fully believe is that we are long shares, and the trades you want to take are to prevent massive downside. So a little bit insurance goes a really long way on something like Tesla when in a week it moves down 10%. And that's the mindset I want to get you into. Leaps are fun, options are fun, but when you want to go long, I think you should fund them in a way that makes their costs much more reduced. You can capture a lot of upside, but at least the premium for your calls are being paid for by generating premium from your holdings. And if you get into, by the way, I hear a lot of people on different YouTube channels talk about they're options traders, they like getting into leaps and stuff like that. I'm not saying you shouldn't, but I think the chart, we'll look at the chart again long term. I don't think the chart is in your favor on leaps unless some type of Cybertruck catalyst blows the stock price out of the water, and the only way that happens is the volumes and the ramp that Cybertruck maybe they prepared really well for this moment, and the focus on creating a vehicle from manufacturing first perspective, like that's their principles, is that we want to create the line in the car itself, and the truck itself, that allows us to, from the get-go, we're just ramping up. Now, I do know the 4860, that's going to hold them back, I think, because you're not really hearing great news on the ramp of, the vertically integrated like battery production for Tesla. And, I wonder what type of batteries can you put into this that can allow them to still produce a lot of the Y, a lot of the 3, the new Model 3, and still ramp up what they need to ramp up, the semi-truck and the Cybertruck, and they need to ramp up their Megapack production as well, because that's so back ordered. Like, those are great catalysts to make your quote unquote leaps look great. But just know that drawdowns in Tesla stock are severe and they last a long time. So even a year out, I just want you to just look at the chart later on today on your own and just pick times. Okay, just pick a 1 year time frame, pick a 2 year time frame, and you realize those leaps that are purchased wouldn't have not worked out for you. The amount of theta being destroyed over the course of that time is really devastating, and that the movement generally has been a downtrend since 2 years back. So a 2-year leap that you would have bought before maybe the all-time high, that is still not working out for you. It is most likely worthless, and it doesn't really make sense. The only time I think the leap should be considered is if you need to raise capital. So if you're trying to maybe we'll shift back to the chart real quick. And I hate to ramble all the time, but if you want to get a leap, it needs to replace 100 shares. I think it's there to give you the flexibility to have cash on hand, where cash is currently king, quote unquote, because cash would have been a much better investment for a lot of people if they were buying above this green and blue line. If you're buying above 230 anytime in the past 2 years, you're hurting because it didn't work out for you unless you're selling massive amount of at the money calls and collecting thousands of dollars every couple months on your shares. Otherwise, it's not working for you. And leaps, if you bought a leap even here, let's say September 21, before the big all-time high run up, you're still below that strike price, most likely, unless you bought some crazy in the money like $200 leap. But think about leaps as try to get them close to the money. This is not financial advice. I'm just saying, if you're gonna go that route, and I can't stop you from doing it, just try to think about it. Like, if you want to buy one leap, that should replace 100 shares. Then what do you do with one of those 100 shares? You get into something less volatile. If you want to stay in the market, so you're buying one leap for Tesla. Okay, I understand. You're very bullish, and otherwise, why would you be listening to this channel? But get out of the shares of whatever that value of Tesla is at that moment. Let's say it's $231 like it is now. And then you can buy $23,120 worth of something like less volatile, which I believe would be the index, the S&P 500. So you can kind of capture that upside with whatever X amount of leaps that you have. And then if they're close to the money leaps, you can actually just convert them to shares if you really want to. If they were to come expire in the money and you really wanted to hold the shares, do whatever you want with your money. But you don't want to subject yourself to that double volatility, double long that I talked to you guys about earlier, where you're like, I'm buying the leap, okay, and then I'm holding hundreds of thousands of shares, and then these humongous 30, 40%, 70% drawdowns are just destroying your portfolio's value. Where you can get that exposure to Tesla with your leaps. I honestly think that it's really more important to actually watch the stock and buy shorter term calls. Stay in the S&P 500, stay in the NASDAQ, whatever, something less volatile, and then you capture those moves with like more tactical calls on a shorter time frame, so you get more volatility, you get more for your money, because leaps are not going to move unless like the delta just goes crazy. If the leaps are not going to move like a shorter term call, like, so let's say you call the bottom here because it's at the top of the range from spring, and you're like, that's kind of the area when I bounce, I'm going to buy a call 1.5 months out from now. That's going to be a great move for you, because you kind of understand like, okay, I'm just trying to capture like a couple percent move over the next couple weeks. If you're in a leap, I think mentally you're gonna have a problem closing that leap out. I think you're gonna be like, I need to hold this until it goes up by 10,000% or something, and it could happen. I'm not saying it can't happen. Maybe we're due for an all-time high very shortly, but just know that if the move is gonna happen in the next 2 months, imagine if you had a 2-month call instead of like 2.5 year leap. Number one, mentally, you probably will get out of that call much easier than getting out of that leap. And of course, it will return much more money for the investment. Not financial advice, it's just saying like if you own Tesla calls in numerous amounts, you're already capturing that great volatility. Should your holdings honestly be Tesla? I don't know. I don't have the answer for you. But if you're getting into leaps, I think every leap should be replacing 100 shares. 100 shares should be invested then into an index of some sort. If you have every batch of 200 shares, let's say what is the S&P 500 right now? $439 on the SPY. So if you have like 200 shares of Tesla, being replaced by two long-term, really long leaps close to the money, you can just like take that $46,000 and like buy 100 shares of the SPY, and you're not going to subject yourself to like, okay, this stock just dropped 10%, my leaps just dropped 50%, and you're like, what? Okay, I know. I'm sorry. I hate to be preachy, but just look at this chart, and leaps haven't worked. They haven't worked unless you're buying leaps. I don't know, November 2020, and you'd be up. Not that great. I mean, you just holding the shares would have been much more effective if you're buying leaps in 2020. Actually, holding the shares would be, you wouldn't have 3 years of theta destruction on your leaps. Okay, so let's go back to the chart real quick. We've been talking about China. I'm sorry. We'll go back to the browser real quick. We've been talking about China a lot, and on China, so we talk about a good catalyst for a nice move in the market would be some type of stimulus for China's. But China's stimulus is just, I think they're becoming to understand that there's very little they can do to expedite the recovery of their economy, and it's really more of like they are so in debt on the local level, on the individual level, that there's no amount of money that's going to fix that situation. Where China is actually just trying to stabilize their financial institutions. They're trying to keep the country from just imploding, instead of trying to like create more debt for themselves by throwing thousands of dollars of money into the pockets of just regular people. And plus, there's kind of whispers saying that Xi Jinping is not interested in bailing out the individual person because he doesn't like how over the past years that his people have kind of evolved into that kind of Western style of consumerism. He's not really interested in that. He doesn't think that's really what the future China should be like. But regardless of that, here in the highlighted area, it says China trimmed its one-year loan prime rate, which is mainly used as a benchmark for corporate lending, from 3.55 to 3.45%, but left its 5-year equivalent, mainly used to price mortgages, at 4.2%. It didn't change the 5-year. It doesn't care about, look, no one's going to be buying more homes. No one's buying anything there. Just like we talked about how on Friday there's no confidence to do that. And number two, they don't have the money to do it in the first place. So why encourage buying more homes when people are not paying for their mortgages for homes that are basically not built yet, or are built and they're not being occupied, or they're occupied but not paying? There's a lot of issues very similar to our great financial crisis in 2008 here in the United States that they're going to go through. And they're probably maybe trying to understand, like, how did we really focus at first on how to fix that issue? We just keep the banks alive, and that's what they're trying to do firstly with their next interest is, so they have concerns with the health of the banks, but also what I think they're really wanting to do is just kind of keep the local governments and the provinces just stable enough to survive. These are really debt laden local governments who rely on, just like any other local government, relying on like the real estate interest, real estate taxes, I'm sorry, to pad their coffers. And with people not paying mortgages, leading to the devaluation of their homes by 75% in some areas, they're not able to collect a lot of taxes. And you can kind of seek that in municipalities here in my state in California, where the flight during COVID and of course the high interest rates have been putting a lot of pressure on the ability for cities, counties, what have you, to collect enough revenue to fund their services locally. And China's kind of dealing with that as well. At the end of the article, which was from theguardian.com, an interviewee went on to say, every time the economy is weak, there is borrowing to finance real estate construction and infrastructure. And so this insulation of the property market from corrections is really just coming home to roost now. So basically over the past years, and you've heard about those ghost cities and like empty apartment buildings and condo buildings, that was used to prop up the GDP growth targets that these local municipalities were trying to satisfy. They had tough targets to meet GDP growth from the central government, and they just can't do it anymore. And I think China's central government, they understand that. Xi Jinping understands. They put some tough quotas on these governments, and they're just trying to keep them afloat. But the country is so indebted that what do you want to do? Put $10,000 in the pocket of each person? It doesn't necessarily fix the problem. It doesn't make the mortgages. I'm sorry, the real estate value go up. That these real estate companies and real estate trusts, they are basically all bankrupt. So there wasn't much stimulus. So there was kind of hesitation when it came into the opening market trade today. And we can kind of look at that. Let's go over to the chart and look at the S&P 500. And you can see it had a much different action than Tesla and Nvidia did today. Even though it had a really nice day. And if you count the bottom at the open, that would have been an amazing trade for you, just like catching a Tesla trade. I think the S&P 500 trade was actually a very decent trade because you can capture that move with a shorter duration call, for instance, or what have you. Because on a Monday, a weekly call on Tesla is not the greatest mover. Whereas a 1 day, 0 day to expiration call on the S&P 500 would have been a really, really nice move. And you could have captured that twice. You could capture up until lunchtime, and when it sold off, you can capture it again. So decent move. It gapped up, sold off, went up again. So there was some good moves to be had there, but it wasn't a very confident move compared to the moves like the Nvidia and Teslas of the world. So why is that? Why is the market kind of questioning itself early in the morning enough to close the gap on the S&P 500, not really close the gap on the QQQ? Let's go look at a smaller time frame. You can see that where the Qs kind of floated above, just being really influenced by Nvidia and Tesla, who had better moves than some other tickers. Well, it's really because of we don't understand why this is happening. Is because of the yields. Here's the yields for the here's the yield compared to the indexes for the U.S. 10-year compared to the NASDAQ and S&P 500. S&P 500 is going to be in orange, NASDAQ's in blue. And typically you see when yields peak, the market is weak. And you can see that some examples of that here in these light pink lines. When the yields are peaking, the market sells off. But as the yields stayed flat for most of the day and up considerably at 1.8% today, the market was catching a bid throughout the entire day. So it kind of begs the question, how are we reconciling much higher yields to the point where yields are closing at highs that we haven't seen for, I don't know, decades, maybe 2009? Let's look at that. Let's look at a longer time frame. Let's say a 6-month time frame to try to understand where have we seen these yields before. And it is 2011 that we're getting to now in the 30-year. And on the 10-year, let's take a look at that. On the 10-year, we're seeing these yields beat it out from it actually is higher than 2008 on the 10-year. How is that possible that we have these yields so high, yet the market didn't collapse? Great question. No one really has a great answer to it. But yeah, I mean, this is something that could be a real, how do I say this? A real catalyst to bring stocks back to a reality within the middle part of this week. Look, how can you guys as investors and traders buy up Apple, Microsoft, Nvidia, and Tesla, and what have you, in the face of these yields? Now, it can be because they believe these companies will survive regardless of the yields. And in the case of Nvidia, let's look at Nvidia. In the case of Nvidia, it's because their consumer base is rich with cash. We're talking about companies that are sitting on tens of billions of dollars of liquidity that they can buy thousands and thousands of AI chips for. So they're not really concerned. Nvidia is not concerned about your gaming card no one cares about that. That's not going to really move NVIDIA all that much compared to increased guidance because of the amount of AI chip orders and realizing, and the market realizing that maybe the backlog that NVIDIA has is, yeah, it's growing, but it's getting through that with increased production and more diverse sets of AI chips, and so that the NVIDIA customer is not really the end user right now. That's not really going to move the stock. It will help if everyone's buying graphics cards for their computers, but NVIDIA is like, think about NVIDIA like Lockheed Martin, where Lockheed Martin's main customer is the government. So the yield on the government's, the yield can affect how much the government spends to maintain the debt it has out there, especially at high interest rates. It can be a real drag, but there is billions of dollars in backlog orders for Lockheed Martin, and it's a good for some people it's a good investment because they know that the customers are not regular people like you and me, super sensitive to interest rates. It's the governments across the world who must spend to rearm their armed forces, and of course in America's case, arm other armed forces of the world, Taiwan or the Ukraine. So think about NVIDIA like that, where yields are high, but NVIDIA might actually be able to overcome the typical drag that are higher yields. What about Tesla? Well, Tesla could be more of a story about, okay, so number one, it's very oversold in the likes of in the minds of many investors and traders, with RSIs very low, being drawn down for 2 weeks, 3 weeks straight, basically. And this could just be like a technical bounce. But on a long-term story, it's Tesla hopefully, number one, bringing cost of goods down, but secondarily, that it has the ability to gain market share with price cuts and what have you, survive this environment more than other auto manufacturers. We'll take a look at that in a couple of minutes. So let's look at NVIDIA and Tesla real quick. We've seen NVIDIA track the performance. I'm sorry, maybe inverse of that. Tesla tracked the performance of NVIDIA over the course of that whole run-up of the AI euphoria, even outperforming at certain parts in time during the middle part of the summer. Right here, you can see that right here in the orange line. The candles are NVIDIA. Now, NVIDIA did diverge from Tesla's performance last week, basically a week ago, where it found a lot of interest as people really are piling into this name for NVIDIA's earnings. This is why it's going to be so important to Tesla, because this is something Tesla followed for a large portion of the year. And NVIDIA's very much outperforming. Does Tesla close this gap ever? Who really cares? We just want Tesla to go up. It doesn't need to close a gap, but it can be sucked up into the vacuum left behind by any movements that NVIDIA has. So that'll be kind of nice to see Tesla start moving more in line with NVIDIA, which it did today. You can see the very similar move up. It's a gap up, a slight sell, very slight sell, and then a nice buying into the close for these two names in particular. Now I want to compare this move to Tesla's move to the other auto manufacturers, because is this a move in line with all the other auto manufacturers, or is this Tesla resuming its AI boom euphoria instead of auto manufacturers having a better outlook in the economy? Well, let's look at our typical auto sector evaluation here, where it's GM, Ford, Rivian, and Tesla, where Rivian reflects kind of that smaller market cap but higher volatility, more of a startup type of price action. Tesla being Tesla, Ford and GM being the OEM representatives for legacy auto. And you can see just over the past day how Ford did not have a market move, GM and Rivian neither. So this move is simply a move of the resumption of an AI thing, NVIDIA like trading, whereas Ford, it's up but not so much. GM, not so great, especially the close. GM's close is not great, and Rivian didn't have the greatest close either, and was not up the same percentage at all. And you would think that if there is this EV euphoria instead of the AI euphoria, that Rivian would capture a bigger move. But let's look at Rivian real quick by itself. And let's turn off these comparisons. And Rivian had a really ugly close. This is the 1 minute chart on Rivian. It didn't have some crazy gap up. It didn't have buying into the close. It actually was relatively flat respecting this level for itself, which is basically $21. It doesn't have a nice move after hours like Tesla or Nvidia has. And so that's Rivian being up today. Rivian's up 1.9%. Tesla's up 7.33%. And we can just track them together so we can have a good idea that maybe the move from today from Tesla is not about EVs. Is there a resumption in the AI trade? Something to wonder. And you can see how Tesla gaps up very largely and outperforms all day in more of a flattish trade, unfortunately for Rivian. But whenever Rivian does, catch a bid, it'll be a very violent move to the upside. We're talking like 10, 15% moves within a day or so. I want to bring up another chart, something that represents like meme-like small cap names, Upstart, something that no one knows what they're doing and what they do. Let's see how Upstart did today. Upstart had 3.9%, so it's an okay move after being down like a quadrillion percent like this. But yeah, it had a very sharp sell-off from the 70s, and it's still not really making any notable highs. So the move today wasn't like a meme-like move. It didn't really get supported by that. We're talking about stocks that are super, super shorted, like your Carvanas of the world, your Upstarts. We can see that Carvana had a respectable 2.8% move, but that's not really a great move when it comes to stonks or meme-like stocks. So Tesla's not following in their footsteps. The move is not about super shorted stocks moving up really, really fast, because if there's a short covering event for a Carvana or an Upstart, you would see moves like somewhere in the range like 7 to 15%. And we can look at Palantir, which is like a small cap AI name. How were those performing? And you can see it's not that great. Had selling into the close, and it's really, really oversold, but not doing that great still. And it was only up 0.69% for one of the one of the great AI names over the past couple of months. So the yields are still suppressing these smaller cap companies. Mega cap companies can maybe overcome because they self-fund, they have free cash flow to invest in their company, to grow their production still. The capex is not going to be a total issue for them, hopefully. And smaller cap names like the Palantirs of the world, even though I understand they're doing a buyback and what have you, they're not moving like Tesla or Nvidia does, who are your kind of anchor AI names from past 2 months ago. So yeah, so Tesla had a great day today. I still want you guys to be aware that a bottoming process takes more than just one day. Sometimes it takes a couple days maybe to form a bottom. You can kind of see that here when we started moving off of the lows in spring. That there's a process to it. There's still kind of a small or short-term consolidation to a bottom, but you can see some nice moves off the very bottom. This was a move of so when we bottomed in April and started moving up for the summer, it was a move up of around 8.3%, right? So what about the absolute bottom here? This is a bottoming process again. Look, I see this will gap up, it trades flat, sells off, gap moves up, and there's a process to a bottom, right? But how about from the bottom? What was that move from the bottom? That was like a 21% move in 3 days. So the moves are violent at the bottom, yes. They can retrace violently as well, or at least it would just take a couple of days to kind of realize the bottom. But what's some good structure that we're seeing here for a potential bottoms? We talked about RSI last week. We talk about the buying after hours instead of the selling after hours, and we'll just do a quick circle for something that marked a reversal for us before at 200 $90 something a share before quarter two earnings. Is that we have the island reversal. Okay, so it's a gap down to form this island, a gap up to finish the island, and then so like we don't want to make new lows necessarily, and we don't want to fill the gaps. We want to leave the gaps for the rest of time and never see them ever again. So I like to stay above 225. Below 225, I might be short in my mind. Being below 220, probably much more short. Something to think about. But for now, the price action was good today. I'm glad that we had a green day. It was a really big green day to really compensate for the losses that we've been seeing in our share price over the last couple of weeks. So thanks so much for listening, guys, and have a good night. Bye.